Well, good morning, everyone, and thank you so much for joining us today. We do recognize that there's other things going on in the country today, so we're happy that you chose to join us for this nonprofit tax and industry update. As Christine and I were preparing for this today, we kind of look back at the description that we wrote, which was probably in late November, and realized that what we thought we were going to present back in late November changed somewhat significantly within the last 3 weeks, just due to the new COVID legislation. So hopefully what we're able to present to you here today still meets your needs. And yes, we will be trying to address as much as possible to give you an update as to where things are today with respect to nonprofit tax. And what to think about and expect for the future. So my name's Kim Hendrickson. I am partner and in charge of exempt organization tax here at Eidl. I reside in our Minneapolis office location, and I'm joined by Christine Perez. And Christine is a manager who works with me in exempt organization tax. We're both part of our firm's national tax office, and Christine is out of our Boise office. So today we're going to start by looking at the ever popular COVID-19 legislation, both with a little bit of a look back at what's happened in 2020, and then a look forward to 2021 and what we can expect with respect to some of those provisions here in 2021. We're going to talk about some recent exempt organization legislation. So in addition to all of the COVID-19 legislation, Treasury has also kept us on our toes with some new updates and final regulations within the last couple of months. We'll talk about some tax filing updates, some things that you should be aware of as we look at the 2020 filing season, and then some trending tax topics. So with that, let's jump into COVID-19 legislation. So just to do a real brief recap, just to, take a step back in time, going all the way back to last March. So the first legislation that we actually had with respect to COVID when this became a national pandemic was the Families First Act, that requirement to provide emergency leave for employees, and then to be able to get a tax credit for that leave that was provided. Then we had the CARES Act. That was the big one. That was the one that included our PPP loans, that included the employee retention credit, the emergency disaster loans. It had some Main Street lending in there. Lots of different things that were really designed to help stimulate the economy and to help protect people who were being significantly impacted by this pandemic. In April, the PPP loan became operational. And the PPP area really was, as we look back over the prior year, that was probably the provision where we spent the most time working with organizations. I'd say as a firm, both for-profit and nonprofit organizations, and helping individuals and organizations figure out what those rules meant, how you could get your loans. Now we're working on how do you ensure that you can get those loans forgiven. So that continues to be an area that we're spending time in. Then in summer, we had the PPP expansion. So as you remember, we ran out of funds. So those funds had to be expanded, and in order to get money into more people's pockets. The Main Street Lending Program. So the Main Street Lending Program was designed really for organizations that weren't those small organizations, those less than 500 employees, but employees that were larger. And it was a loan program that was established for those entities, not forgivable. So it wasn't a forgivable loan, but it was supposed to be on terms that were more generous than a normal loan program. I think it's interesting to know on the Main Street Lending Program that there was $600 billion authorized under that, And by the end of 2020, only about $4 billion was utilized. And the real big issue with the Main Street lending as it really played out was that it was really difficult to access, and the requirements were really prohibitive. So that unfortunately didn't end up being as good of a program as one would have thought. And that brings us to December and the Consolidated Appropriations Act, which is where we are today. So we have this Consolidated Appropriations Act. It was signed into law by the president on December 27th. It was a great present for those of us that work in this area between our Christmas holiday and our New Year celebration. And really, as we look at the provisions that are in that and this new COVID release legislation, what you're going to see is it's a lot of the same things that were in the CARES Act, but either expanded, or more importantly, a lot of the provisions were actually modified in certain ways, either to codify some of the frequently asked questions and some of the guidance that came out over the course of the last 9 months, or to truly expand it based on some of the concerns that were out there with these programs. So with that, I'm going to turn it over to Christine. Christine has been our PPP guru and has spent a lot of time in the last 9 months, and especially in the last 3 weeks, answering questions with respect to the Paycheck Protection Program. So she's going to give us a little bit of a update as to what's new and different with the PPP.
Perfect. Well, thank you, Kim. As Kim mentions, I've spent quite a bit of time working with organizations as they've gone through both of the first round draw processes last year in 2020. And then now we're looking at this additional funding. So really with the Paycheck Protection Program update, we did see an additional almost $300 billion of additional PP funding available. Now that funding is available through the end of March. So organizations that are applying for these PPP loans do have until March 31st of this year to apply. And when we talk about the loan, I did see, kind of when it first came out, it was showing as PPP2. I think that led to a little bit of confusion for a lot of people as to what it meant. It really is a refunding of the program, and it does allow for both first and second draw loans at this time. So we've got applicants right now that had a PPP loan in 2020 that are now going to be looking at our second draw loans under the program. That was newly created with the update. But we also have organizations that are newly eligible or may not have received a loan in 2020 that are now looking for a first draw loan under the program. With the additional eligible entities that we saw the program open up for, 501c6, that was our big group of organizations, but it does also allow destination marketing organizations, local newspapers, TV, radio stations, and also housing cooperatives. And there are some limitations or requirements that need to be met, and we will cover those for 501c6 entities next. And, we also saw an expanded definition of payroll costs. The Act does allow employer group, health, life, disability, vision, and dental insurance contributions. They've specifically said that those are okay. We saw the modification of the covered period definition. So for the PPP loans that we saw last year in 2020, it was a case of, select an 8-week period, or you're going to use 24 weeks. Now you can choose a covered period for your loan anytime between that 8 and 24-week period. And then lastly, we have on here slight change in the treatment of the EIDL grants. The Act essentially eliminates the requirement for those EIDL advances, those up to $10,000 emergency payments, from being subtracted from the PPP loan forgiveness. And the SBA has indicated that if you had the advance amounts previously deducted from your forgiveness amount, that will now be remitted back to the lender along with interest to those organizations. Let me move the slide. All right, so Our 501c6 and destination marketing organizations newly eligible here in 2021 for the first draw loans as of the 11th. Now, these organizations, we're going to include our business leagues, our chambers of commerce, real estate boards, boards of trade, but the provisions specifically exclude any of these organizations that are professional sports leagues or organizations that specifically promote or participate in political activities. Now, the requirements for this first draw funding, you cannot have more than 15% of your receipts from lobbying activities. The lobbying activities may not comprise more than 15% of your total activities. And the lobbying activity costs do not exceed $1 million in your previously or most recently filed tax year ended prior to February 15th. So lastly, the organization needs to have 300 or fewer employees. When we're looking at that count, when we talk about the employee count for these requirements, we're looking at your average employee count on a monthly basis over your previous 12-month period. So most organizations are going to go in and calculate that based on your 2020 employee levels. Lastly, the SBA really has not provided some specific guidance at this time when we look at the interpretation of what exactly is lobbying. So it's currently unclear whether an applicant should utilize, the Form 990 definition of lobbying or what we see from the IRS, or if you need to go back to the Lobbying Disclosure Act to determine those lobbying activities. Absent for further guidance, and we'll probably get clarification. The IRS defines lobbying as an attempt to influence legislation. So, and as I mentioned, eligible for the first draw loans, so that is going to be your 2.5 times payroll or a loan up to $10 million. Our organizations that are eligible for the first draw are not subject to the second draw requirements. Okay, there we go. 2021 first draw loans. So our eligible entities, those are our organizations that were in business as of February 15th, 2020. It covers our original applicants, again, 500 or fewer employees, or those that meet the SBA size guidelines or requirements. And then for our newly eligible entities, the 501c6 organizations, that cap is 300 or fewer employees. The loans, again, are eligible, so kind of the same guidelines as before, 2.5 times your monthly payroll up to $10 million. And in calculating the maximum amount that you are eligible for, you can use either your 2019 or your 2020 payroll amounts. Now, our first draw loans, kind of similar. Forgiveness provisions look exactly the same, other than the fact that you can now use any covered period between 8 and 24 weeks. And then we also have those additional expenditures or covered expenditures that have been added in. So you do need to use your funds, 60% or more for payroll, 40% or less for the other covered expenditure amounts. 100% can be forgiven for your loan, and you must meet those FTE and salary requirements. All right, let's see if I can get it back to the slide. All right, for our second draw loans, these are going to be our entities that already received PPP funding in 2020. So you've already received your first draw loan. Now you're looking for a second loan this year. When we talk about the timing for getting this loan, technically you must have just received the funds from your first PPP loan before you can apply for a second PPP loan or that second round of draw. So there was some new guidance that just came out from the SBA. They released it last night on the 19th. And they have gone in, they've clarified that, you can technically apply for these two around the same time. You could submit your application for your first draw loan and then go in and submit the application for the second draw loan. You just have to make sure you've used those first round funds before you receive a second draw. You can only receive one second round draw for any organizations that are looking for the funding. You are limited to the 300 employees calculated in the same manner I mentioned before, look at your 2020 average payroll count or the last 12 months. One of the big items in here is that you have to meet a 25% or greater reduction in gross receipts for 2020. The current rules allow you to go in and compare your quarters. So you could look at Q1, Q2, Q3, or Q4 of 2020 and compare it to that same period in 2019. The legislation or the rules do allow you to also look at your 2020 annual receipts in comparison to 2020 to determine that amount as well. Let's see, I will add in here that we've had a lot of questions recently about gross receipts and in calculating the 25% reduction. The first round of guidance that came out really said, hey, for a nonprofit, your gross receipts need to be defined in IRC section 6033. What does that mean? So when we interpreted that, we were thinking, okay, how do you calculate on the form 990? The guidance that was released last night as of 1/19 does indicate that the SBA has shown you can calculate your gross receipts based on how you calculate gross receipts for your form 990. So that is in reference to section 8, your statement of revenues. Go in and calculate in that manner. If you wanted to, you can take your financial records for the quarter. You would line it up with how that is calculated for 990 purposes to prove that 25% or greater gross reduction. And then the new forgiveness parameters, $150,000 or less, also just released by the SBA last night. New loan application, the 3508S form. It replaced the one they had previously that was for small $50,000 or fewer loans. It has now been updated. It's a one-page application for loans of $150,000 or less.
Christine, can I ask you a quick question
Yes.
before you move on? And that's with respect to the gross receipts. Did the new guidance indicate whether gross receipts is going to include the first round PPPs that would, effectively usually be treated as a contribution or grant revenue?
Right. That's a great question. So the guidance currently indicates that your first draw PPP loans, your EIDL loans and advances, those are excluded from gross receipts at this time. So you would pull those amounts out. However, we do not have good guidance right now as to whether other types of relief funds, such as provider relief funds, higher education emergency relief funds, or state and local grants, whether or not those are actually included in gross receipts. So I know that the AICPA has some requests out, so we're hoping that that guidance will also come soon.
Perfect, thanks.
Yes. So I already chatted a little bit about loan forgiveness. So this is just kind of another slide. Of course, our nonprofits, we're looking for up to 100% forgiveness. You need to make sure that you meet the criteria to be eligible. So in this case, we want maintenance of your FTE calculations and your salary levels. That's kind of the same as what we saw last year in 2020. There are still the safe harbors and exceptions that can be met for organizations. And again, we've got the same caps on our payroll and other eligible expenditure spending. So the 60-40 split. With regards to the documentation, this is the same as before. When you remit your forgiveness to the lender, you need to make sure that you've got your payroll records, your quarterly 941 documents, and then for your non-payroll costs, be able to substantiate them with account statements, agreements, invoices, receipts, canceled checks, whatever you can provide to the lender to substantiate those amounts. And then remember, we've got the new kind of covered expenditures that you can apply. So I think for a lot of organizations, we're going to be looking for those PPE supplies to protect employees, cost for sanitization of your space. If you had to do anything to promote social distancing per the OSHA or CDC or Department of Health guidelines, those costs can all be included now in that 40%. So for loan forgiveness, for submission, you really have until the end of the cover period or your loan to get that submission in, but really you want to get it in within 10 months of the last day of the covered period. So if you select something less than 24 weeks, that's going to start the clock running for when you want to get this into your lender. When you submit your application for loan forgiveness, you know, your lender has 60 days to approve your application. And then from there, once it goes through your lender, the SBA has 90 days to approve your loan forgiveness. And again, you do have, for a second round draw, you know, if you've got your first round draw application in, great. If you don't have it in yet, you're still eligible to apply. You just need to make sure all of the loan proceeds are utilized. Let's see, as I mentioned last night, the SBA has updated their loan forgiveness applications. So they have updated the 3508, the 3508EZ, and then that new 3508S has been updated to reflect the $150,000 in forgiveness. And then our last note on here covering the 3510, you know, it's still out there. The 3510 goes in and it's essentially kind of a necessity questionnaire for our loans over $2 million. So at this time, it only applies to those organizations that are receiving the first round draws. This has been a really controversial form. You know, it's got a lot of requirements that were not stated up front at the beginning of the PPP loan program. It's a time-consuming form. The lenders are also requesting this within 10 days of your loan forgiveness application submission. So, you know, if you do have a first draw loan over $2 million, be prepared at this time to fill out that form for your lender. Then we've got a slide here on financial statement treatment. You know, I would caveat that the best people to talk about how it's going to be reported on your audited financial statements are going to be our audit teams and your audit team members. But, you know, there are kind of a couple of different treatments that are going to apply. So if you have audited financial statements, we're looking at ASC 958-605. And typically what we're going to see is if you have received formal recognition from the SBA that your loan is forgiven, it is going to be included as a grant for the year. You also have an option under this ASC if you have met all of the requirements for forgiveness, even though it might not have occurred by, say, 12/31, you also have that option to report in your revenues or your contributions for the year that loan forgiveness amount. If you are treating it as a cancellation of debt, it's other income. If your loan will not be forgiven, it is reported on the balance sheet as an unsecured third-party loan, and you would accrue interest for the year. You know, we have a kind of a question on here. What about organizations that are not audited? You know, in this case, I would revert back to kind of how the Form 990 new instructions were released. When we look at Part 8, the Statement of Revenues, it does indicate that you can treat on line 1E as a government grant the amount that is forgiven in that tax year. Now, when you look at what it asks for, what's loan forgiveness, it just indicates that you've met the employee retention criteria and that the funds have been used for eligible expenditures. So the position you take, make sure that you document it if you are going to include that loan forgiveness in your prior year when it was received. We've got some tax considerations. So again, as I mentioned on our Form 990, we're typically going to see the loan forgiveness reported on there as a government grant on line 1E of Statement 8 on the Statement of Revenues. When we think about our public support percentage, if we're treating this as a government grant, it should have a positive impact. The government grant contributions, they're not subject to either the excess contributor or the disqualified person rules. And it's going to actually increase our public support percentage that we see on Schedule A Parts 1 and 2. You know, if it's treated as a cancellation of debt and it's not forgiven, it would have a negative impact or possible negative impact on our Schedule A. And then as a reminder, our forgiven loans do not produce a taxable income at this time. If it's forgiven, report it as the government grant, and all of your eligible expenditures that did give rise to the forgiveness, you would still deduct those and they would go on your statement of functional expenses. With that, I think I will turn it back over to Kim.
All right. So with another provision under the SBA is the economic injury disaster loans. So those Eidl loans, these loans have always been out there. They've always been available for nonprofits and small businesses. The difference between the Eidl loans and the PPP loans, a couple different things. One, there's no forgiveness available for these loans. So different from the PPP where you can apply for forgiveness. If you do get one of the Eidl loans, they are not forgivable. They are a 30-year fixed loan, and there is an automatic deferral of 1 year on the payments. The interest rate on these is a 2.75% interest rate. So and that's specific to nonprofit organizations. The limit on these loans through the CARES Act was supposed to be $2 million. I think some of the commentary that we've heard and just in talking to different nonprofit organizations that it seemed like 150,000 was kind of an unofficial cap, that a lot of organizations didn't get more than that. And these loans do need to be used for payroll, working capital, normal operating expenses. Now, Christine mentioned earlier that there was this advance payment available, and the advance payments really was treated as a grant. So it was a grant of up to $10,000. They came out with later guidance that was actually going to be based on the number of employees. So organizations with less than 10 employees were getting $1,000 per employee. Organizations with no employees could receive $1,000. So that may be an option for some nonprofit organizations that wouldn't be eligible for PPP loans because that's based on employee and employee cost. So if you are truly just a volunteer organization, there could be this opportunity for a grant under the Eidl payments. What we're hearing is that funding was just directly deposited in people's bank accounts. A lot of times organizations didn't even know it was going to show up. They had applied for it, but it would just end up in their bank account. And we do have an extension of this through the new Appropriations Act. So there is additional funding available for the Eidl grant program. So there's $20 billion allocated to this. And a lot of the funds that are being set aside for this are for some very targeted funding with respect to low-income, certain low-income neighborhoods, really with the intent of getting money into the hands of those that are most significantly impacted by the pandemic. So last I had looked, and Christine, I don't know if you've seen different, but this program is not currently eligible. It's not open for funding or for application, but similar to the other programs, we expect it to be up and running soon. So if you go out to the SBA website, there's a big coronavirus placard out there. If you click on that, you're going to see the links for both the PPP and the Eidl program and the new program that I'm going to talk about next, which is the Shuttered Venue program. So the Shuttered Venue Operators grant program is a brand new program as part of the 2021 legislation. Those of us here in Minnesota had heard about this earlier because this was the bill was originally called Save Our Stages program. So I remember hearing about this being proposed maybe back in September, October, with the idea of a lot of these live music venues, these arts performance centers were really being negatively impacted because they had to be shut down due to the pandemic. So this new legislation appropriates $15 billion of grants specifically for the entities that are listed. Key to note here, we still are waiting for guidance as to what this really is going to look like, how it's going to be implemented. There's still, SBA is indicating they're still in the process of setting up the application process. And so they currently are not accepting applications. However, there is some information out on the SBA website. And again, if you're an organization that falls within the potential to get these rules, make yourself familiar with that so you're ready to apply when or if you become eligible. So the eligibility requirements for this, it is open for both nonprofit and for-profit entities. In order to be eligible, you need to show that you've had a reduction of at least 25% of your gross earned income in at least one quarter in 2020 as compared to 2019. Now, we don't have a definition of gross earned revenue. So whether that is similar to what Christine talked about with the PPP, where for nonprofit organizations, it would look at your Form 990 revenue. The fact that they put earned revenue in there makes it, you question whether does that include contributions or does not include contributions when we're thinking about a nonprofit organization. So again, more to come on that. The organization has to be in the process of or have resumed operations by the date that they get the grant. They have to have been in existence in 2019, although there's some flexibility as to whether you were in existence for the whole year. And then there has to be a certification of need. So similar to what Christine mentioned with the PPP loans for those the larger loans, there is going to be a certificate of need. So to be able to show that because of the impact of the pandemic, the organization had significant impact on its ability to operate. Organizations that are ineligible, if they received more than 10% of their revenue from federal sources in 2019, again, we don't have a definition exactly of what that looks like, but anticipate that it does not include any kind of disaster assistance. Key here is that they can't receive a PPP loan after December 27th. So in other words, these organizations can't get both a shuttered venue operator and really either a second draw or a first draw loan in 2021. So this is going to become a key thing for organizations, is to think about what's going to get you the better answer. Is it to go for a PPP loan, either a first or second draw, or is it to go after the shuttered venues grant? And then it's only for employers of up to 500 employees. So as you see kind of throughout all of this, there's definitely a focus on getting the money to the small businesses, which I guess makes sense since this is run through the SBA. Okay. So what's available? So the funding is limited to $10 million per entity, and there are some affiliation rules in there. The initial grant is 45% of your 2019 gross earned revenue. And then if there is funding still available, there's an opportunity for supplemental grants of 50% of that initial grant. And that's going to be calculated if your 2021 quarter one revenues are not more than 30% of your 2019 quarter one. So definitely you're going to have to be a math person to be able to figure out all of these different calculations and what makes more sense when you're thinking about the shuttered venue versus the PPP. Eligible costs, it's any costs that were incurred from March 1st, 2020 through December 31st, 2021. Very similar to the costs that were covered under the PPP, with couple exceptions, but probably the most notable is that this can include payments to independent contractors, which is a really key provision, as a lot of arts organizations are paying independent contractors. So it was key that it didn't only include payroll. And then there is a priority disbursement here. So up to 80% of the funding is going to be distributed in these different waves. So the first 14 days, once the program is up and running, is going to be for applicants with revenue decline of 90% or more. Then we're going to go to the second 14 days, and that's going to be organizations with a revenue decline of 70%. And then after that, it would be opened up for other organizations. Now, I was out on the SBA website yesterday, and on the website, it actually seems to indicate that these first 28 days are limited to organizations with 50 or less employees. Now, that's not consistent with kind of the wording in some of the actual legislation. So I think that's going to be another thing that's going to have to be kind of straightened out here. But what I would tell you is if you're one of these organizations, read through the requirements, make sure you can meet, because there's, in addition to the eligibility requirements in general, each of those 5 different types of entities have additional requirements within them. So get comfortable with that. Make sure you understand if you truly are an eligible entity, and then be prepared to apply whenever it fits with this priority distribution. All right, the employee retention credit. So this is a little bit of deja vu. So this is one that was out there in 2020. Probably didn't get as much play as the PPP, and the primary reason for that is that the initial rules said you could not do both. So you couldn't apply for a PPP loan and get the employee retention credit. And so most organizations looked at this, and especially if you were an organization with less than 500 employees, and decided, well, that PPP loan was a much better option. The employee retention credit gives a payroll tax credit for organizations who were either fully or partially suspended, had their operations suspended during any quarter in 2020, or experienced a significant decline in gross receipts during a calendar quarter. Those definitions have changed, so we'll talk about that as for 2021. But a key thing to know at this point is the IRS did change that rule with respect to the PPP borrowers. So you now can be eligible for the employee retention credit, and you can go back to 2020. So if there are payroll costs that you had that were over and above what you used for your PPP loan to justify the forgiveness of your PPP loan, those payroll costs could be eligible for the employee retention credit. So we do feel that there is some opportunity here for you to think about 2020, especially if you meet this definition of either fully or partially suspended or had a significant decline. So here's what the rates are. So effectively, this is a credit of a certain amount of eligible wages per employee. So for 2020, it was 50% of eligible wages. 2021, that goes up to 70%. The credit is a refundable credit per employee. So in 2020, it was $5,000 per year. In 2021, it's only eligible right now for 2 quarters. So that gets us to $14,000 over those 2 quarters per employee. And that's because the limit on the qualified wages you can include per employee in 2020 was $10,000 per year, so 50% of 10,000. In 2021, it's $10,000 per quarter. So for the 2 quarters, we'd have $20,000 eligible. 70% of that gets us to the $14,000. The key change here really is this threshold for a large employer. So in 2020, a large employer was anyone with over 100 employees. In 2021, that changed to 500 employees. And why that matters is with respect to who an employer can take the credit for. So for large employers, they can only take the credit for employees that they were paying who were not providing services. So think of people who were furloughed, or people who, you know, you continue to make payments to, but they were not working. Small employers could take the credit for anyone who was getting paid regardless if they were providing services or not. So that's a real big key differentiator. So moving this threshold up, I think will open the door for a lot more organizations to be eligible. The other big thing that's going to change is this threshold for reduction in gross receipts. So in 2020, you had to have a 50% reduction comparing to the same quarter in 2019. 2021, it's 20% reduction of your 2019 or the prior quarter's receipts. So that again is going to open the door for a lot more organizations to meet this requirement of an eligible employer. So I would advise everyone to kind of take a look at this employee retention credit, especially if you were in a situation where your revenues have decreased or you had your operations suspended. We'll touch a little bit on provider relief funds. Christine and I are definitely not the experts in this, thank goodness, because we think our life has been crazy. Those people who are dealing with provider relief funds, I think it's almost weekly. It seems like things are going back and forth. But the only thing, or a couple things we'll mention here, is that there was additional funding in the provider relief funds, an additional $3 billion. We did get information last week that the reporting timeline with respect to provider relief funds has been delayed. So the reporting for the prior relief or provider relief funds was supposed to start January 15th through February 15th. They have pushed that back. Organizations can go out to the website and get registered, but you can't actually go in and do any of your reporting at this point. There have been some changes with respect to the lost revenue calculation. Originally, or within the last month, they had indicated you could use the guidance that was released in June 2020 in the frequently asked questions. The information that came last week gives you 3 different options, which were in that guidance, but it's basically that you could use lost revenues between 19 and 20. You could use the difference between your actual revenues and budget if the budget was approved prior to March 27th, or you can use any reasonable method. So the full impact of this is unknown. There continues to be conflicting guidance between what's coming out in guidance, what's out there in frequently asked questions. So if this impacts you, my recommendation at this point is our team that's covering provider relief funds is having a webinar on the 26th, so next Tuesday. Go on our website, sign up for that. They will be able to give all of the information on what's really happening at this time with respect to provider relief funds. And then just a couple other provisions. Employment benefits. So within the CARES Act, there was a provision to cover 50% of the cost of unemployment benefits for reimbursing employers. That's been extended through March 31st. The Families First has been extended through March 31st, but the mandate to provide leave was not extended. But if you do provide that leave, you can get the credit. And then the repayment of the deferred employee payroll taxes has also been extended through the end of the year. Then the last thing that we'll touch on with respect to this legislation, charitable giving provisions have also been extended through 2021. So this is the above the line deduction for donations, cash donations. The dollar amount for 2020 was $300. For 2021, that was expanded to $300 for singles, $600 for married. This really is a key provision that I would encourage organizations to encourage your donors to take advantage of this. This is we've been pushing for this, and the industry has been pushing for this above the line deduction for a long time. Now that it's there, Congress needs to see that people are taking advantage of it, or it's going to be hard to ever get it again. So really do encourage donors to take advantage of it. It might not seem like $300 or $600 is that big of a deal, but from an overall industry standpoint, it really is. So with that, I'm going to turn it back to Christine. As you can tell, there's lots of information here, so we're probably going to go a little fast through the rest of this stuff, but we'll see what we can get through.
Perfect. Yes, we will plan to kind of cruise through some of these slides. So when we talk about some of the more recent legislation, 512A6 or the siloing rules, it's been on our radar for a little while now. This came in back in 2017, but they released the final regulations December 2nd, 2020. So, when you're looking at the siloing rules, that's it. They're applicable to tax years beginning after December 2nd, 2020. However, at this time, since it was put in place in 2017, your organization should be looking at either the proposed regulations that were previously released. You should be looking at the final regulations for 512A6, or you should be using some sort of a reasonable method of siloing your UBTI. So when we talk about siloing, we're talking about calculating unrelated business taxable income separately for each of your unrelated trade or business activities of the exempt organization. For some organizations, this is going to cause a little bit of a headache. We can't put everything in one pot for UBI anymore and kind of offset the losses in income from different activities. So, the final regulations that were released, they look very similar to the proposed regulations. We did a seminar probably mid-2020 in July where we covered this topic. So that's a good reference if you'd like to go back and watch that webinar. It covered the proposed regulations. The final regulations look very similar. The final regulations indicate that to silo an activity, we can still use the 2-digit NAICS codes. We still have the investment silo for our activities. So certain qualified partnership, S corporation interests, and debt finance property will move into one investment silo. Our qualified partnership and qualified S corp interests will need to follow the de minimis or the participation tests. Now, in order to be qualified in that investment silo, there was that name change. It used to be the control test. It's now the participation test. And the final regulations still have that primary focus on our C7s and our VBAs and our subs, indicating that UBI and the silos are calculated slightly differently. The common example there is kind of the golf course, the 501c7 golf course. You can't go in and group all of your unrelated business activities in one silo. You need to separate out your dining. You need to separate your green fees based on 2-digit NAICS codes. So we'll quickly go over this slide, but really, when we have the investment silo, we're looking at some of the qualified partnership and qualified S corp interests that we receive. So in general, we're looking at the K1 received by the nonprofit organization. If you're under 2% of the profit interest for the de minimis test, or if you do not hold or control more than 20% for the participation test, your K1 or your investment activity can be siloed into one activity. There are a couple of look-through rules if you have a multi-tiered partnership or investment. And then also kind of that rule, if you have a K1 that is over these limits, it does not meet the de minimis or participation test, those will need to be looked at under the 2-digit or NAICS codes for the specific siloing. Partnerships, if they're over 20% and they're the same activity, you can group them together. S corporations, it doesn't work like that. Each S corp K1 that's over the 20% or does not meet your participation or de minimis test, you would silo it individually. So the final regulations kind of touched on expense allocations, but not great detail. The IRS always reverts back to saying that, there's no formal guidance. You need to use a reasonable approach for your allocation method. The final regulations under 512A6, they just state in there that if you use gross to gross and it's unadjusted, that's typically not acceptable. But that's about as far as the guidance went for the expense allocation. So just make sure you use a reasonable approach. Lastly, in the final regulations, we've got some considerations for NOLs. So when you're looking at the siloing rules, there are ordering rules that apply. Essentially, those NOLs that you generated prior to the siloing rules being in place, or the pre-2018 NOLs as they're called, those are going to be used first. You would use up all of those NOLs against your total kind of gross income from the year. Then you would start applying the post-2017 NOLs, or those NOLs that have been generated by your siloing activities. And remember, siloing of NOLs, they carry over if you cannot use them against that siloed activity. You cannot offset them against a different silo. And then when we talk about NOLs, just kind of a quick note, the Tax Cuts and Jobs Act went and eliminated the carryback provisions for NOLs. And it also put into place an 80% of taxable income limitation. The CARES Act, March of last year, suspended or temporarily suspended some of these rules. It allows you to carry back certain NOLs that are generated through the end or the beginning of 2021, carried back 5 years, and it allows you to use up to 100%. That 80% limitation is no longer in effect for those NOLs. And you can carry back certain fiscal 2017 NOLs 2 years. The IRS does have some specific guidance regarding NOLs and the siloing rules, and we've provided the link below.
Great. So I'm going to touch on a couple other provisions here. So we have the excise tax on executive compensation. We received final regulations that were released on January 11th. They are not effective yet, so they're effective as the date that they're published in the Federal Register, which we expected to be yesterday, but I'm not sure that I saw that they actually were issued. They expected those to get issued before the new administration took place. So possibly they may have come in today. But I think what I'm going to touch on with respect to this, we will be issuing a insights article to go into more detail on what these rules really go into. But I think the key takeaway is this executive compensation tax is a tax on organizations who pay more than $1 million to any employee or who have an excess parachute payment. So we have a lot of organizations that will say, I don't have to worry about this. I don't pay anyone close to $1 million. And that's probably true. I think the two things to keep in mind and where we see this potentially coming into play are three places. One is if you have deferred compensation plans that could at some point in the future push that individual over the $1 million threshold. Two, if your organization potentially could give a parachute payment to an executive who's leaving, and the excess parachute payment here doesn't hit that $1 million. It's based on 300 times the individual's normal compensation. And then the third place that we're seeing these rules coming into play is with respect to organizations, so tax exempt organizations that may have a related for-profit organization where the individual is being paid by that related for-profit entity. The way these rules are written, those individuals could get pulled into these rules if they serve on the board of the organization, even if they're providing services to the organization, even if they're actually not getting compensated by the nonprofit organization. The final regulations and the proposed regulations had some clarification and set some exceptions with respect to those types of employees. So that's right down in the second bullet point as far as the exceptions to the definition. But like I said, most organizations aren't going to be impacted by this, but don't, close your eyes to it completely, because there could be that potential in certain situations. The other excise tax that we got final regulations on here in 2020 was the net investment income of certain private colleges and universities. This is a 1.4% excise tax on the investment earnings of these organizations. Over in the United States, there's 40 organizations that are subject to this excise tax. So I'm not going to spend any more time on it, because most organizations are not impacted by this. And then the last reporting requirement we had this year was with respect to Schedule B and some issues and rules that had been in play with respect to whether non-501c3 organizations had to disclose donors on Schedule B. And the final rules that came out say that only 501c3 and 527 organizations need to disclose the names and addresses. All other organizations only need to disclose dollar amounts on Schedule B. So if you're a non-501c3, these would impact you there. So Christine, I'll let you touch on real high level the tax filing updates.
Sure. Kind of if we're just looking high level to close out our presentation today, it's really that the IRS is moving to electronic filing. So if you're not already filing your annual reporting form electronically, it's probably coming within the next year for most electronic forms. With respect to applications, the Form 1023 became electronic in April of 2020, and the IRS has just released earlier this month the 1024A for 501c4 organizations electronic as well. And there will be an ability to submit the 2848 power of attorney forms and the 8821 for the representatives. That's going online. So that should be an easier portal access to get those signed and submitted to the IRS. And then lastly, we've got a couple changes to the Form 1099 reporting. You'll be working with the BOSS services team, but really, the 1099 was split for reporting purposes this year, and they've moved up a couple of the dates for getting those forms submitted.
Great. Then with respect to some trending tax topics, the slides will be available to everyone. If you didn't get them at the beginning of the presentation, they will be available at the end of the presentation or after this. So we, I think there's good detail in the slides, so we won't touch on all of them. I do want to just touch on the IRS and Treasury comes out every year. This was as of November, and they say, here's what our priorities are going to be. So their priorities through June 30th of 2021 was to finish some of the implementations of the Tax Cuts and Jobs Act. So we did see that was the push for getting all of these regulations issued. There's some guidance that's coming out with respect to group rulings. We do have a slide in here on that, but really what it means is moving forward, they are going to change the rules with respect to what types of organizations can get a group ruling, which basically means smaller organizations can fall under a parent entity or and not have to apply for their own standalone tax exempt status. A lot of organizations that currently have this would be like the Boy Scouts of America, or a number of the church organizations have a group ruling. We don't anticipate the changes will impact the organizations that currently have group rulings. There will be some grandfathering in, but there will be changes moving forward. Some guidance on when LLCs can qualify as 501c3s. Final regulations on supporting organizations. These have been proposed for 4, maybe 5 years. They are saying that we are going to get final regulations, but this has been on their priority guidance for 4 or 5 years. Some guidance for private foundations, investments and partnerships where disqualified persons are also partners, and then regulations for excise taxes on donor advised funds. So there's another slide in here, but donor advised funds definitely continue to be an area of significant discussion and concern with, and the primary issue here is with respect to the fact that there's no requirements for payouts. So effectively, a donor can take a tax deduction by putting money into a donor advised fund, and those funds never have to be distributed and actually used by charity. So we anticipate there could be some payout requirements coming out there. Just quickly on some IRS initiatives where they've said they're going to focus their compliance efforts. Hospitals with unrelated business income, and particularly where there's been losses shown. I am aware of at least a couple hospitals who have already started an audit with respect to this. So the IRS is looking at this. C7 non-member income, exempt organizations that were operated as for-profits and converted to exempt organizations. What's the difference? What are you doing different now that you're an exempt organization? Private inurement, self-dealing continues to always be something they're looking at. With the exempt organization unit is now combined with the payroll or the employment tax units. So there is always work being done on worker classification, backup withholdings, and they continue to use data-driven approaches by looking at the forms that are filed and having certain red flag type questions that trigger examinations or trigger compliance checks. There's the group exemption, donor advised funds. We just put in quickly here, IRS is definitely backlogged, as many of us are, with respect to the shutdown that happened. Returns aren't being processed as quickly as they usually are. They're not being sent to GuideStar. They're not being put on the IRS website. So we have a link here. If you want to understand what's happening at the IRS, you can go to that website. And then in the healthcare arena, we continue to see exemption challenges. How are 501c3 hospitals operated any differently than for-profit hospitals? What are they doing with respect to debt collection? What are they doing with respect to charity care? And lastly, we'll leave you with our favorite irs.gov resources. So the first one is tax exempt organization search. Many organizations are familiar with GuideStar, where you can pull copies of 990s that have been filed. The IRS actually has a good place on their website now where they are also uploading 990s, they're uploading organizations determination letters. So GuideStar now does have a limit on the number of times you can pull returns. So if you're tax geeks like us and you're pulling people's 990s on a regular basis, there is some limit there. So we now find that this tax exempt organization search is a great place to go. The IRS also is issuing snapshots, which are designed to be training type articles on specific topics with respect to tax exempt organizations. They probably put out 5 or 6 of them last year. And there's some pretty good technical information if that topic tends to pertain to your organization. And then just, where's my application for tax exempt status? If you're an organization who's waiting to hear on your tax exempt status, there is a place on the website where you can find that. And I believe that currently they're saying that they're looking at applications that were filed before May 25th of 2020. So I need to take a quick breath here. Trying to get through all of those hot topics in an hour is a lot of information. Thank you for hanging in there with us. We are happy to take additional questions through the Q&A function. And like we mentioned, we will make sure to get back to you specifically on those questions that you have answered. So with that, thank you again for joining us. Please feel free to go out to the iBailey website for additional information. Things are getting posted there almost daily with respect to legislation. There's articles and there's webinars. You know, keep yourself informed, and here's our contact information. If you have any questions that come up after this, feel free to reach out to either Christine or I.